Good afternoon, everyone. My name is Colin Day. I'm a financial advisor with Correct Capital Wealth Management, and you are with me today for one of our quarterly financial wellness webinars. We host this, as you can probably imagine, quarterly to make sure that if you're participating in one of our 401k plans, where we serve as your financial advisor, you're a client, you're an interested party in terms of just getting some education around retirement planning. That's why you're all here. So when it comes to today, and considering it is December 17th as we record this, I thought, well, what better time than right now, 2 weeks ahead of the end of the year, to talk about some year-end tax planning. Now, especially for our clients, they would know that we like to do tax planning with much more forethought than just give you 2 weeks to be able to work through this. But the whole idea here is that I wanted to provide some ideas for you to consider that are still well within reason of doing within the last 2 weeks of 2024. So just to dive in a little bit, this is a disclosure just to mention that this is not tax, legal, or investment advice. If you do have those types of questions, please consult your professional network or myself. If we are your advisor, we are happy to have a chat individually. This is group education, so I'm not providing any solicited or unsolicited advice at this point. All we're doing right now is providing with some good education so that you can possibly go forward and make some decisions for yourself. But we're here if you have individual questions for us as best as we can. So for those of you that are unfamiliar, tax planning is one of those pillars of the Certified Financial Planner designation. It is a major part of most financial advisory firms in the services that they provide their clients. And what tax planning is, if you're not familiar, it's that process of paying the least amount in taxes over your lifetime, using the best education information at our disposal. So unfortunately, tax law changes, right? The most significant legislation we had was the Tax Cuts and Jobs Act back in 2017. That's of most recent memory. Before that, there were many other iterations of tax proposals, things that have been passed, things that have failed that could influence you in the future. So all we're really trying to do when we talk about tax planning is that we are trying to use what we believe to be true now and in maybe the not too distant future to better educate ourselves so that we pay as little in tax over time. And as I reminded a client yesterday, that means sometimes we pay more tax in one given year for the benefits in future years. And we'll talk about some of those ideas in a coming slide. So in other words, we're paying what is legally required of us. We're not trying to skirt any tax rules here without leaving the IRS a tip. The IRS will welcome additional funds if you provide them to them. They're not going to give them back unless you have a good reason to get them back from them. So why is the year end so important? Well, it's because much of the things that we do are recorded on the calendar year, January 1st to December 31st. There's some nuance to this. There are some things that we can do past the December 31st date line. But what we want to try to do is get all that stuff, get all our ducks in a row ahead of that if possible. December is a great time to do this because there's a lot of things that happen over the course of the year that come into view now. So we have a good idea as to what our income is. So if you're paid regular wages, or if you're part-time, or if you have bonuses that might get paid out before the year end, hopefully this time in December, we have a clear idea as to what that might look like for you. Tax withholding. You have a good idea as to what tax withholding you've already done and what may need to be rectified or prepare for come next year. We'll talk about that more in a moment. Also, charitable donations. If you are charitably inclined and you've made donations or are thinking about it, you have a clear view of how those charitable donations may help your tax situation if you were to claim them as a deduction. So we're going to talk about multiple things here. I've got three major ideas. The first one is probably, well, it's probably the thing that we don't talk about enough, which is tax withholding. And more specifically, the IRS withholding estimator tool that is on the IRS website. Now, I do talk to a lot of people that get very nervous at the beginning of every year. Why is that? Well, it's because their tax year has been completed and now it's January, and they have to figure out, did they do everything that they should have done so that they don't have a nasty surprise once they file? So if you're filing your taxes and each year you're white knuckling it, so to speak, where you're thinking, man, I really hope I paid enough to the IRS, and if applicable to my state organizations, or like here in this in St. Louis area, if you work or you live in the city, the local taxes, did I withhold enough? Well, it could make a lot of people lose sleep because they just don't know the answer of what they're looking forward to. Some people that assume that they're always going to get a refund, every once in a while get a nasty shock, and we don't want that for you. So one way to help calm your nerves is to use this IRS tax withholding calculator. So if you've never seen this before, type into the Google machine, IRS tax withholding estimator, and you'll be brought to a page that looks just like this. There's a how it works, there's what you need. And then there's a link or a button at the bottom that says use the tax withholding estimator. The tool is very simple. The whole reason we use it is to, at least from the federal side of things, try to figure out if we're in the ballpark of what we owed for over the course of the year. You can even do an exercise like this a couple months earlier, say like October, to get a pretty good view of any withholding changes you might need to make. The things that you need are things like your pay stub. That's probably the best item to have at your disposal, if applicable, both you and a spouse. Have those pay stubs available, because what you're going to do is you're going to input all that data into the calculator. It takes about 10 to 15 minutes, depending on how fluent you are in pay stub speak, to be able to get a good idea as to whether or not you will owe, or you're in a situation where you might be estimated to get a refund. So here's an example of one of the outputs that we helped a client work through recently. So you could see here this result on the federal side again. The expected tax withholding for this individual was going to be $30,140 through their job. Now, because of the deductions and other things that are going on in their lives, whether or not they have kids and they get the child tax credit, whether they're contributing pre-tax or Roth to their 401k, all those things are being considered in the estimator, and you're providing that information. In their particular case, the anticipated tax obligation was $29,314. So the projected refund on the federal side for them was $826, which is pretty good. When you have a tax liability that size, to get within about $1,000 plus or minus, whether or not you owe or get a refund, that's pretty good. So, but the whole point here is that what we want to do is for you to feel very comfortable with where you think you might end up with your withholding. Again, this is something that you could do months earlier, say like in October, and that should make you feel even better about the situation, because if you do need to make a withholding change because this isn't a projected refund, maybe it's a projected owed amount of a couple $1,000s, okay, you can go into your pay stub, you can make an update to things like your W-4, so then you can better anticipate things in future years. So again, this is only for federal. You can see if your state has an applicable state withholding estimator. It'll be the same type of ideas, but you might need to use some of the federal data to be able to determine whether or not this works. So again, if you are worried about your tax situation, always consult your professional to see if they can model things in software, or if you're a do-it-yourselfer and you're doing things through the online version of H&R Block, TurboTax, whatever it might be. You, of course, can punch your information into there to get a what-if situation and feel very good about whether or not you're going to be anticipating getting a refund or whether you're going to owe anything. Okay, so that's year-end tax idea number one. Here's number two, Roth conversions. Every year, it seems that since the Tax Cuts and Jobs Act was passed, every year, Roth conversions, because it just becomes more and more of a conversation. We actually had to update our financial planning tool to something that could better work with our clients' requests for more information on Roth conversions, so that when we work with our clients' tax preparers, they feel really confident that we've got their back and that we're involving their tax preparer in the conversation to make sure that we're not making an oopsie by performing a Roth conversion. Now, you might be a deer in headlights right now wondering, what is a Roth conversion? Well, we need to answer some questions first to see if a Roth conversion is even something you need to consider as an individual. So first of all, one of the things we want to think about is, would you prepay your taxes on your retirement withdrawals? Do you want to get those taxes out of the way? Then also, when we think about what this thing actually is, the literal movement of money is what's creating what the IRS is going to know as a Roth conversion. So conversion itself is when you're moving money that was previously untaxed to an account that is taxed. Another way to think about that is you're taking money from, let's say, your 401k, where you got a tax deduction as you put the money in from your pay stub. Now, when you withdraw that money in the future, you're going to owe tax on it. So you're going to get taxed at some point. But what we're doing with the conversion is that we're prepaying the taxes. We're moving that previously untaxed money into a taxed account, and whatever amount we move over in there is the amount that gets included on our income. So pretty simply, if we think about this from what are the kinds of accounts we're talking about here, traditional IRA, that's generally a pre-tax account with some exceptions. Same thing with the SEP IRA. If you've got a 401k balance, if you've got a 403b, 457, all these different kinds of workplace retirement accounts. Those types of accounts could be converted into a Roth IRA. Now, just a word of note, some retirement plans allow what's called an in-plan Roth conversion, which is a fancy plan provision which allows you to move money from your 401k to the Roth part of your 401k. So you're actually doing this all within your workplace retirement plan. It's very rare that it's offered. And so that's why I put Roth IRA over here, because we know that a conversion can always go to a Roth IRA, but your mileage may vary when it comes to a 401k or a retirement plan that you have through your job and whether you can perform a conversion. So again, we're taking money that is pre-tax, hasn't seen Uncle Sam's eyes yet. We're moving it into an account where it absolutely is. Now, it allows us to take care of the tax on this money now, which is great because there's a lot of uncertainty as to what taxes could look like in the future. So regardless of what tax laws might be passed in the future, you're prepaying them. So provided you think that you're in a lower tax situation now than potentially what you could be in the future, that is certainly something that we consider here. If for whatever reason your politics say that I'm worried that taxes are going to go up in the future and I want to get the taxes taken care of, that's another reason why people perform Roth conversions. But remember, the amount you convert is included in your taxes. So you might be listening to people talk about Roth conversions and just use round numbers. Let's say you have $100,000 in your 401k plan right now, and it's all pre-tax. Again, hasn't been taxed yet by the federal or state governments. If you decide that you wish to perform a conversion of $100,000 in that account and move it over into a Roth IRA in this example, well, $100,000 is going to get included onto your income for this year. And it is included in addition to any other income that you have to report. So again, if you are working, that can be a big tax bill for you because you just raised potentially your tax bracket because of that $100,000 of income that you're now talking about here. So we generally wait until the end of the year to make a decision as to whether our conversion makes sense. There used to be some fun reasons why we could do it a little bit earlier in the year and then hit an undo button. Unfortunately, all that's gone away. So now the general guidance is that if we're going to perform a Roth conversion, let's wait until the end of the year. Because again, I have a better idea as to how much money you've made this year, what your income's going to look like. We can model some ideas as to where we think we were going to be from a tax bracket perspective, and then we can make a really good educated decision on whether or not a conversion makes sense. And if it does, what the dollar amount is that we should be considering. This is, well, and I'm glad I put that note at the bottom there because this is where we want to involve your tax preparer. Because what we don't want to do is convert $100,000 believing that it is in your best interest to do so. And then you go do your taxes and your tax preparer is like, whoa, time out. Why did you do this? You didn't involve me on this. You didn't consider this other thing that we've been working through on your taxes. So for many people, especially for DIYers, when we're doing major conversions, where again, doing $100,000 plus in conversions, we may want to involve your tax professional because while we are not signing off on our clients' taxes, we can provide ideas and best laid plans, but we can't confirm what our data is showing is going to be the truth. And so that's why we work in partnership with our clients' accountants and CPAs to make sure that they're making good, educated decisions on a Roth conversion. So that is why we always want to make sure that this goes through. As I mentioned a moment ago, there used to be some fun ways that we used to be able to do conversions earlier in the year. We had to stop doing that when the Tax Cuts and Jobs Act came out. Now the conversion is irrevocable. Whatever we do, whatever we convert, that gets included on your income. So this is something we need to take very seriously. If we're thinking about doing a conversion, not everyone is going to be a conversion candidate, but for those people that do want to pursue it, that's why we involve your professional network. Okay. So that was me waxing poetically on Roth conversions for a couple minutes. Let's talk about idea number 3, tax loss harvesting. And I will apologize because I know nothing about farming. I know that there's snow on the ground. I don't think you can call this harvesting, but to each their own. I found a picture of a tractor harvesting. It just came to mind. When it comes to tax loss harvesting, what I am more fluent in is why we use this for our clients, especially as we head into the year end. And like all of you, I hope that you had a great investing year. I'm showing this just as an illustration. This is the S&P 500 index, the year-to-date performance as of yesterday morning to be exact. And you could see that the S&P 500 was up actually 28% over the course of this year so far, which is phenomenal. And again, if you participated completely in the stock market, wonderful. I bet you had a really good year. The challenge is is that not everybody has a good year every single year, right? And even in some years where your accounts might be up double digits, you might be in a situation where not every security in your portfolio is in the green, so to speak. You might run into some stinkers in there. So for example, within that S&P 500 index, and if you're not familiar, the S&P 500 tracks the 500 largest publicly traded companies in the US. One of those companies in there is Walgreens, and that's what I'm showing here. So Walgreens did not have a very good year. They're down about 62% year to date. Same thing with Intel. So they were down about 57. So for every good performing security within the S&P 500, there are probably a couple that didn't do as well within there. So when we have some losers in our accounts and we're thinking, what is the long-term focus of this particular security? It doesn't make sense for us to continue with it. We perform tax loss harvesting. So when we feel like it's time to cut ties, so if we had Walgreens in our portfolio amongst dozens or however many securities we have in that portfolio, and we decide, hey, Walgreens should no longer be a part of our holdings, and we make that decision, well, we're going to cut ties. We're going to perform the tax loss harvesting. So it's harvesting those losses by selling the poor performing securities. Now, we do a couple different things when we sell a stinker. As this is a technical term, of course, a stinker. When it comes to the things that we try to accomplish by selling things that are at a loss, one is that we can reposition that money into other securities. So one security may fall out of favor, but we have an idea that there might be something else that we want to position that money to. So, and I'm just using Walgreens as an example here. Let's say Walgreens doesn't have a good outlook, but we like that space and we think CVS might be a better option. Again, I'm just using that as an example. But we're going to reposition that money into something else so that it's still productive for us. The second thing that it's doing is that we can use those losses to net against gains on the other securities. So again, if you had the S&P 500 and you were up 20 some odd percent, but you also had some losers in your portfolio, well, you may realize some gains on those securities if you were to sell. So if you sold part of your holdings, and let's say you have a net gain on that account of $10,000, you did really well in the security, you decided to sell, and you're going to go on vacation with the proceeds. Well, if you have a $10,000 gain in there, you're going to pay some form of capital gains likely on those securities. Now, what you do to offset that gain is to tax loss harvest. So if you have that another security in your portfolio at a $10,000 loss, well, they may offset each other. We become what we call tax neutral. So by selling the security, we're offsetting some of those losses or some of those gains so that you don't have to pay so much when you go to file. Now, the other thing here is that if you do the tax loss harvesting, well, let's say you have no gains anywhere and you just sold securities that you no longer wish to have. Well, you can use up to $3,000 a year to deduct against your earnings. So that could be a way to lower your income technically for the year by reporting the loss on your 1040. Now, it's up to $3,000 per year. And let's say if you have $10,000 in losses, well, that's more than three. So the other 7,000 would then roll over to future years. So again, if in that year you have capital gains that you can offset, wonderful. If you want to use that for other purposes, you could use it in different ways. Okay, so it doesn't all have to be used in one year, and for many it doesn't, and it could help you in future years if you have big gains. So again, we don't like losing. I don't want you to have a poor year in the market ever. But the reality is that's very hard to remain consistent in your performance. So we use tax loss harvesting strategically every year. Right before this call, I had an email go out to a client about this very topic because we're trying to figure out, in their particular case, it's option number 2. We have some gains. We want to offset those by selling a stinker in the portfolio. So as long as there's a reason that we no longer wish to hold this thing in our portfolio any longer, that's why we want to pursue it. So yeah, not losing every year is important, but when we do lose, unfortunately, we're going to try to use that to our advantage in different ways. All right. So those are the big 3. But however, it wouldn't be a Colin presentation if there weren't bonus ideas, because I always have more ideas than probably the time allows for. So here are a couple things to think about here. Maxing out your accounts. Interestingly, even though this is December, there are certain kinds of accounts that you can fund that impact your taxes post December 31st. So I break this down into two different buckets. So here's the first one. So here's some example accounts that have deadlines for the end of this year to be able to document some form of deduction or tax opportunity for you. So, for example, if you participate in a 401k plan through your job, or you work for a nonprofit and you have a 403b, if you have a 457b because you work in the government, deferred comp, those types of things. If you have those types of accounts, December 31st is the last day for a deposit to be made, technically, for you to get a tax deduction. Now, a dependent care FSA, so this is for those of you that either have maybe children that are in daycare or kids that are, or adults even that you're looking after that require extra care. Those types of accounts also have that 12/31 deadline. Healthcare FSA, so that flexible spending account that you can use for your health related purchases, that also has a funding deadline of the end of the year. But again, interestingly, there's lots of accounts actually that don't use the December 31st deadline. These are the ones that go all the way up to the tax filing deadline, which traditionally is April 15th, give or take a couple days, depending on whether or not it falls like on a holiday or a weekend. So those examples would be traditional IRAs, Roth IRAs, simple and SEP IRAs, as well as health savings accounts. So if you are in an HSA eligible plan and you wish to fund your 2024 contribution, you actually have until April to be able to do that. So this provides some flexibility for folks because you might not know if you're eligible to contribute to a Roth because you might make too much money. That's why they push the deadline back until the end of the year so that it's very clear whether or not you are eligible to do that. Same thing with a SEP or a simple IRA. You might actually have until the tax filing deadline, including extensions, which could actually result in October 15th being the date that you could influence your 2024 return if your preparer filed that for you. But again, when it comes to this particular strategy, we want to have a very good idea by the end of the year as to what path we're on, and then be able to know, okay, here are the accounts that absolutely need to be resolved by the end of this month. And here are the accounts that we have a little bit more time to at least do the funding aspect, but we still want to have a clear idea of what we're planning on doing. All right. That is the presentation that I have for you all today. I know we talked about a whole bunch of stuff, and I've given you 2 weeks, right? There's nothing going on in those 2 weeks. There's no holidays or anything that anybody will be celebrating. So you got plenty of time to work through all those things. But the idea here, again, is to get your mind working in a way where if you do identify something that could be of interest to you, maybe there's one or two things, maybe there's just one, maybe there's nothing. Maybe you've nailed it. Congratulations if that's the case. But I just want to make sure that you all know that, hey, there are some things that you need to absolutely think about before the end of this year, some things you have a little bit more time on. And even if this year, 2024, isn't the opportunity where you wish to utilize some of these ideas, you always have next year. And you could set reminders on your phone or in your workplace calendar to make sure that you're thinking about these things. So you might set up a reminder in October to make sure that you're doing the withholding calculator. Maybe by the beginning of November, you're making sure that you're going to fund your 401k to the fullest extent that you're able to. Things like that, so that you could set some guideposts along the way so that when it's the last 2 weeks of the year, you don't feel a lot of stress now that Colin's given you suddenly a lot of input. All right. Okay. With that being said, that's my commentary. I'm going to pause. I'm going to grab a drink of coffee real quick for a second. If you do have questions, feel free to unmute yourself. If you are more comfortable in the chat, feel free to just type into the chat your questions. I'll be happy to address them. All right, you're telling me no questions, which is wonderful. That means I nailed it. That means I did a really good job in my year-end planning to make sure that you all didn't have any questions by the end of this presentation.
I actually have one question, if I
Go
can.
ahead. Yes.
So I will not max out my 401k because of job changes this year. So what are my other possibilities?
In terms of making sure that you put enough money aside for retirement planning?
Yeah, is there any other way to put money into the 401k, or can I put
I
money
see.
into an IRA, or is there something else I can do since I won't max out my 401k?
Yeah, good question, Jill. So when it comes to the 401k, because there is that 12/31 deadline there, you might still want to fund 2024 related accounts, right? In that particular case, like you just said, IRAs would be the option there. So you have the traditional and the Roth IRA. Those are probably the most common two accounts that people might want to fund. And as long as you are denoting when the contribution goes to those accounts that it's meant for 2024, not for 2025, that's the key. So for example, we will have clients call in let's say March, because they're getting their taxes done, and they say, hey, Colin, I'm eligible to make a Roth contribution. I want to put $7,000 into my Roth IRA, please and thank you. So we know, because we're their advisor, that they want that denoted for the year 2024, not for 2025, because they're going to go to their tax preparer and say, hey, I made a 2024 contribution to my Roth. And you could show them the Fidelity report or the Schwab report or whatever it is that you host these accounts on to be able to denote that. So you absolutely, while you can't fund the 401k any longer to affect 2024, the traditional and the Roth IRA are probably those two accounts that most people will use. Again, it's just important that when you make those contributions yourself or through your advisor, that you're making sure that they're reporting it for the correct tax year. Does that help?
Yes, absolutely. Thank you.
Thanks, Jill. Any other questions? Oh, I see Tracy joined this late. Yes, this presentation will be made available later. So however you receive the invite to register for this webinar, you will also be given the link. We put all these on our YouTube pages. So there's two ways that you could resolve for this. You could subscribe to our YouTube channel, which is just Correct Capital Wealth Management. I would encourage everybody to do that. We are so close to getting 100 subscribers. I mean, that would be such a cool Christmas/Hanukkah gift for me if we can get up to 100 subscribers. You will see that once it's loaded immediately. Either that or the person that sent you the registration link, they will also forward that on to you. They will have that link probably within the next week or so. But thanks, Tracy. Okay, any other questions? All right. You're very welcome. Okay. Well, it is about noon, my time, Central Time. I hope you all have a wonderful, festive, should you choose it to be, holiday season. Hope everybody has a great end of 2024. If you do have questions for me, again, feel free to reach out. There's my email, colin@correctcap.com. You can just visit us at correctcap.com and get all of our information as well. All right. Thanks so much. Have a great afternoon and have a wonderful holiday season. Thanks.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.